Welcome to the weekly update, where we'll go over the action in the market for June 21st through the 24th, and then see how things look for June 27th through July 1st. And this is a take one video, so please forgive me if I stumble over my words or make a mistake. My other laptop is not available right now that has the editing software that I usually use. Anyway, we had a pretty positive week as it ended on Friday. Most of the week was kind of not really all that much happening. There's a real negative overtone to the market these days, but we saw some real strength on Friday, and we're also starting to see what could be a rotation. And I'll show you some charts, both daily charts and weekly charts, to kind of back that up. But let's go back over the week session. What happened? It was a short week because of the holiday. We had a strong day on Friday, and that ended up leading to a positive week. We were bouncing from an oversold condition, and that's what a lot of people think is happening right now. We went down pretty far, pretty fast, and if we're seeing any kind of a bounce right now, it's just bouncing from being oversold. Well, there's also some other things happening, and we might be seeing a sector rotation into growth. We saw a sector rotation out of growth at the end of 2021, and look where we've been in 2022. Well, we're starting to see the reverse of that now, going out of the more value stocks and more into the growth stocks. Now, this could change at any time, and this takes some time to develop, but that's what we're seeing right now. And I'll show you what I'm talking about there. One thing that's a little concerning is copper is falling. This tends to be a leading indicator of the economy. And I have a chart that I'll show you of that. And then this past week, Chairman Powell did testify one day before the House, the other day before the Senate. His prepared remarks didn't really change from one day to the next. What can be interesting is the Q&A that comes at the end, and that didn't really change anything as far as the markets were concerned. They were sure watching, but pretty much the Fed is determined to deal with inflation. That's the biggest concern right now. And we did see on Friday some strong new home sales. And that's kind of been different than what we've been seeing, especially in real estate. Kind of the general trend has been more down with a lot of the different economic reports that we get. Well, we saw some kind of hope on Friday. And the S&P on Friday was able to regain 3,800 and 3,900. So we ended up being up for the week 6.45% with the S&P. Volume was below average. That's a little bit concerning, but we are into the summertime now. People are very confused about what to do. They're not going to put a lot of money on the line if they're real uncertain or don't have a lot of confidence in what will happen. So we're seeing volume kind of taper off. There are days when we have really high volume, but overall for the week, we were below average. The technicals are negative on the weekly charts. We're seeing some hope on the daily charts, but as far as the weekly charts are concerned, there's a few little glimmers here and there that I'll point out, but mostly we're still negative overall. The markets are really fixated on inflation and interest rates. There's a lot of things going on in the world right now, but that's the number one issue. There's a lot of geopolitical concerns that at any time could come to the forefront and have an impact on the market, either positive or negative. We have the supply chain issues and the things going on in China with them doing the lockdowns. Then they were lessening the lockdowns. Then the last I heard is there's some areas where they're locking things down again. And that might have some supply chain issues because we purchase so many things from China. Oil's been all over the place, but seeing some recent weakness, which might help not only personally at the pump, but might kind of slow things down from an inflation standpoint. Any Fed speak, we got that in the past week with the testimony that Chair Powell gave. Earnings as they're released by each company. There are a lot of recession fears right now. Are we going to be in a recession? Are we not? Well, we have GDP coming out this week, but not the final GDP. This is the third estimate. And that should give us a clue. In fact, some of the different models that I look at, I'll show you one coming up later. One is showing that we're seeing no growth. And I showed that in last week's video. We're not going up, we're not going down. Well, there's another model that the Fed in St. Louis uses, and it shows that we're up. We're actually seeing some growth. So there's a lot of different things coming our way right now that don't give us a real good eye on GDP. The condition of our trend is that we're still negative overall, and it's getting stronger. And I'll have the chart to show you that. So let's go back and look at the week. Right in about the middle here is Tuesday, and we did gap higher. So we got off to a pretty positive start, but then we just drifted sideways. On Wednesday, we gapped lower, but we were able to recoup from that. That was kind of positive. That was something going on internally inside of the market and didn't really move around all that much. Thursday had a little bit of a gap up, came back down, and then we're able to see some late day strength. Friday was the day when we really showed some strength. We really gapped up. In fact, we went above R1 and R2 all the way up to R3, which is usually not charted on this software. And so I had to go in and put the R3 line on there myself, and we were able to get back above 3,900. So that was pretty positive overall. The Dow ended up being up 5.4%, the NASDAQ up 7.5%, the S&P that I'll go through and analyze was up 6.45%, and the Russell 2000 or the small caps were up 5.8%. So we saw across the board strength. This is what it looks like on going back just to the 17th, where it shows the NASDAQ and the NASDAQ 100 did the best, but all of the different indexes were up, with the S&P 500 also performing quite well. And even some of our broader measures like the NYSE were also up. The different sectors, it's kind of interesting. This is part of the potential rotation that we're seeing, where those that were really weak, consumer discretionary, tech, communication, they ended up having really good weeks. In fact, discretionary did the best out of all the different sectors. Those that are more value oriented, like energy, some of the financials, they were up too. In fact, energy was down, but financials were up. Staples, this is the one we kind of want to keep an eye on. It was also up, but not as much as discretionary, which has been kind of the opposite of what we've been seeing so far in 2022. This is, if we go back and look at all the different sectors, discretionary did the best. All of them were positive except for energy. Current market valuation, and they switched things up again. So I don't have that one little screenshot where I can show you all the charts at once at one time, but we are fairly valued right now. And one chart that kind of stands out shows just the aggregate score. This just shows what they've seen over a period of time. They went all the way back to the 1950s to give us an idea. And this is why they're suggesting that we're fairly valued right now. We're below this blue dashed line here. The PE ratio is still overvalued. Until we come down to this yellow line, it's considered to be overvalued and that stocks are expensive. This is one that actually changed. We've dropped below the dashed line with the mean reversion model, which means we're getting closer to this black dashed line, and that's the mean over the historical period of time that they measure. So when we get too far away from that, this tends to act like a magnet and draws it back down. And we're getting to the point where it's not as far away as it had been. As far as sentiment, after Friday, we're still fearful, but we're not extreme fearful as we were before. This shows the chart of what has happened, where we did get extreme fear for a few days there, but we've been able to bounce up out of that. That's typically positive. One thing that's still a little concerning is we got the final reading of the consumer sentiment, and it dropped down to 50. The preliminary report that we received was 50.2. This came in at 50 even. And from what I understand, this is the lowest reading they've ever had. People are just not happy with what's going on right now. At the same time, we're still seeing interest rates going up, And so when you measure the difference between the two, there is still a really wide spread. Sentiment is also pretty extreme right now. It just shows other times when we showed this indicator being really topped out, that just means that we're not real happy right now. So small businesses are pretty pessimistic. We're still holding up okay as far as the economy, according to this chart. This measures the risky loans against the not as risky loans, and it is going up, but we're not necessarily spiking. We also had the Ridex bear bull ratio. The latest reading was at 0.11. It is fearful, but not necessarily at an extreme fearful reading, and certainly not at a real positive reading. We also had the Aai Sentiment Survey, where individual investors are still extremely pessimistic or bearish about the market, and we tend to use this as a contrary indicator. The VIX saw a little bit of a decline in the line chart, and the bar is also showing a bit of a decline. We kind of spiked up with the VIX, and it's coming back down, especially when we saw the improvements on Friday. The Ulcer Index, though, on the weekly chart still continues to go higher. So that just shows there's a high level of fear in the markets. The National Financial Conditions Index, it is going up closer to this dark line, but we're still below that line. If we go above it, then that means we're really running into trouble, but we're not there yet. The NAII for the past week, no, the NAAIM, it came in at extreme bearishness, which oftentimes we can use this as a contrary indicator. These are active asset money managers who go out and try to find the best investments. And when they're selling stocks, this really drops. When they're buying stocks, this really tends to climb. Well, they're really pessimistic right now. Insider transactions, after almost getting back up to this dark line, has decreased over the past week. So this is bullish for the market as well. This is one reason why people are not all that happy, at least in one particular area, is look at how much interest rates have climbed, or mortgage rates have climbed since October of 2021. We've really gone up big time compared to where they used to be. Copper, this is what I wanted to show you. Whoops, I wanted to show you here where it's still in an uptrend overall on the weekly chart, but we have been seeing it really drop down lately. So we just want to keep an eye on that one. Now, there is a daily scenario that you might find interesting here. What we've been watching is the VIX, and what you see here is a longer term chart of the VIX with the 5-period simple moving average. And when we spike up above this red line, which is 0.8, a lot of times, if you look at the chart above, that marks a significant bottom in the market. Well, recently we did spike up, and now we're coming back down right where this red circle is where our current reading is. And we might be getting some support from that after getting really extreme negative. Another thing is, I mentioned rotation in the sectors. If you look at this chart, which is a daily chart, it goes back and it shows the end of 2021 where we were making higher highs with the S&P. Well, when we take a ratio of the Qs, which are growth, against the SPY, which is more growth and value, we see that there was a negative divergence. The S&P was going higher, but this ratio was going lower, as was discretionary compared to the SPY and growth against value. And then after that, look at how the market has behaved for 2022. Well, what we're seeing now is, even though the S&P made a recent low, we're seeing a positive divergence in these same ratios. And that could suggest that a lot of the real smart money out there, they're starting to get out of the more value-oriented stocks and get more into the growth stocks. And that's what really helps the market go higher. Another chart to show you just shows the growth value ratio with the large caps. We're also seeing that positive divergence in mid caps and small caps, where we saw a negative divergence last December. So we're just seeing the reverse of what was happening before. So this could potentially be positive for the market as well. The gentleman who kind of did a lot of research on this. He's with earningsbeats.com. Tom Bowley, I'm not quite, I don't remember his name, but he has videos on YouTube that are freely available to watch. He went back and studied all of the cyclical bear markets going back to 1950. Now, a secular bear market lasts for a long time, but a cyclical bull market or bear market is a shorter period of time and usually within the context of an even bigger cycle. And his premise is that we're still in a secular bull market, but we've been seeing a cyclical bear market within that secular bull market. Now, there's other people that just think we're going in the toilet and that's all there is to it. But he went back and looked at all these different bear markets and then measured how much was their decline. And then he took an average, 27.38%. And then what happened a year later when we finally hit the bottom at that point? Well, the average was 42.59%, looking out 1 year. Now, just to carry that a little further, that means that if we have hit bottom, and if we go with the worst return since that time, that means that a year from now, we should be at 47.13 with the S&P, and after it has risen 29.59%. If we go with the average, we would be up 42.49%. If we go with the best that happened here, we would be up 78.41%. Now, is this going to happen exactly like this? No, it'll have its own variation, if it even happens at all. And this is just a scenario to consider, to keep an eye on. You may disagree with it, but if you really follow what the charts are telling us right now, we need to pay attention to this. And even though you might be a longer term investor, things are going to get better first on a daily basis before they look better on a weekly basis. So it might be to your benefit to keep a little closer eye on things. All right, let's go through some earnings. We are still overvalued. This pushes more towards the bearish side, that we still could go down from here, where the mean and the median for the Shiller PE ratio is anywhere from 15.87 to 16.95. Let's say 16 to 17. Well, we're double that still. So on a historical basis, we still have to come down in price, or earnings have to go up, or a combination of the two. This also is a previous article that I got from FactSet, posted in the last week, where it says the bottom up target price for the S&P had dropped below 5,000 for the first time since August 2021. Blah, blah, blah. Anyway, just know that the target price has been declining as well. The estimates, as far as Morgan Stanley is concerned, and they tend to lowball everybody else, it just shows what their current earnings estimates are in the latest week. And this is the real GDP nowcast, not to be confused with the GDP now. This is showing that GDP will give us some kind of growth of 3.87 right now, where the other one that we looked at a week ago, it's registering 0. Then this also shows that Goldman Sachs has lowered their growth forecast to reflect further tightening, which means interest rates are going to be raised. The dark blue is the Goldman Sachs forecast. The red line is the consensus. And then this is the Goldman Sachs potential growth estimate right in here. And it just means that they're lowering their numbers slightly, as is happening in a lot of different firms right now. This, you might want to stop and pause this. This just looks at valuations using different measurement tools that we use. And these shaded areas, they just show that they're expensive on a historical basis. And one that I use quite a bit is the trailing PE. We also have trailing gap PE. And just look through all of these, and they're showing that we are still expensive as far as the market is concerned. So 3 things can happen. Price needs to come down, earnings needs to go up, or a combination of both of those. FedWatch, where are we at right now? Getting closer to the July 27th meeting. There's an 83.8% chance that we will be at 2.25 to 2.5. That is a 75 basis point move or 0.75% move up from where we are right now. Then looking out into September, there's a 63.5% chance that we will be at 275 to 3. After that meeting, here's the current Fed balance sheet. I don't really have any numbers on here this time, but just to show that it's trying to turn over a little bit as they do quantitative tapering or QT. Looking at breadth, we saw some improvement overall on the past week based on price and volume, but it's still negative. The advanced decline ratio is slightly positive and showing a bit of improvement. New highs, new lows hasn't really started to improve yet. The accumulation distribution did turn up slightly, but we're still below this moving average. Looking at our trend, we are in a strong trend and getting stronger. The red line's on top, so we default to a negative trend where we saw a bit of a turn up with the buying and a bit of a decrease with the selling, but overall we are still negative with the trend. The Arun also showing the same thing, negative. When the red's really close to the top, that means selling. And this green line is buying, and that's really been decreasing. So our oscillator, or the difference between the two, is really quite negative. The mass index is not generating a signal yet. We want to wait for it to come down below this dotted red line, which it has not done. Decision Point has got pretty much everything except their intermediate trend model. That's neutral, but everything else is negative. Looking at the pivot points, we were able to regain some pivot points on the daily charts. Can we get back up to S1 on this chart? That's at about 4,016. And we are well below the 50-period moving average. And here's where I'm going to start sounding like a broken record. Long-term trend, recent death cross, negative trend, even though we saw a bounce. Bullish percent, after giving us a really extreme negative reading, did go back above 30. That's slightly positive. It turns even more positive if it can get back above 50. Chaikin oscillator trying to bounce back up, looking a little better. Chaikin money flow still negative, but showing a little bit of an improvement. The force index also negative, but showing some improvement. McClellan oscillator, it's positive, where it's above the zero line and advancing, where the summation index is still negative overall based on price and volume. All of our momentum oscillators on the weekly chart continue to be negative. Here's the PMO, one of the oscillators. Based on price and volume, it continues to be negative. The percent of the PMOs that are rising, and a lot of this happened on Friday, where we're starting to give an extreme positive reading, seeing a little bit of improvement with the buy signals and still pretty negative with those PMOs that are above zero. RSI is showing a little bit of improvement, but still below 50. The special K is still above the long-term moving average, but rolling over. The Swinland trading oscillator is looking better based on price and volume. Stoke RSI showing a little bit of improvement after giving an extreme negative reading. Kind of the same thing with the Williams percent R, looking better. The Vortex is still negative overall with the red line on top and the green line below. Ultimate oscillator also showing some improvement. Money flow indicator bouncing up slightly. The percent B Bollinger Bands, after giving us almost an extreme negative reading, is starting to show some improvement. The KST is negative overall and has been for a long time. Same with the PPO. Rate of change going back 1 week, where we might have overdone it to the downside a week ago. Well, we might have overdone it to the upside this previous week. The rate of change going back 50 weeks shows that we were extreme negative and trying to bounce. So you can see there's some improvement in these charts, but they're still negative overall. The Copic curve is really not giving us anything right now. We did get back above this 38.2% retracement on the Fibonacci level. Here's a weekly chart from the COVID low to the all-time high. We came down, broke below this support line, but we're able to get back above that. And here's almost an identical chart, little different colors, but This is the 200-week moving average, and see how it's coming right up to the 50% retracement. So it's almost like there's two layers of support right here. As long as we can stay above that, that might give the market a chance to keep bouncing up. Or if we come down, it might provide some support as well. Our Heiken Ashi chart is still negative overall. The Kegi is still negative with it being red. The Renko is still red with our red blocks there. Ease of movement looking okay on a 1 week level, but going back 14, we're pretty much sideways. The point and figure chart, and we're getting this same signal on the daily chart, which is a low pole reversal. And so we have some new X's that were drawn in here on this chart. That's positive. And this, if it can hold on to this and keep going, could suggest things are recovering. 3-line break, though, is still negative with the dark candle. The Elder Impulse system is back to neutral. And the parabolic SAR continues to be negative with the dots on top. Looking at the broad market, here's the S&P and how we've been coming down for 2022, the mid caps and the small caps. Again, some of you may not find this kind of a chart all that useful. I like to just sit and look at it. Sometimes you see things when there's no moving averages or there's no studies placed on these charts. So I just like to look at blank price charts sometimes. All stocks saw a little bit of a bounce over the previous week. Mid caps, okay, death cross, negative, recent bounce. That's kind of going to be the stock answer here. Same thing with the small caps, the Dow, the NASDAQ 100, NYSE. It actually held up a little better, and that's good to have a broad benchmark like the NYSE to really hold up support better. And the Wilshire is also much more of a broad measurement. It had a bit of a bounce the past week. The FANG stocks were up 9.27%. ARK had a pretty good week, but look at all the damage that needs to be repaired. It was up 18.12% on the week. The software companies still are negative, but they did bounce this past week, 8.72%. Here's Dow Theory looking, again, these should look almost identical, where we've been seeing some real weakness lately in utilities, but over the last week, we're seeing some improvement there. The CRB index, this is what's starting to maybe slow down, although it's still in an uptrend. And we're still in an uptrend on the daily chart, and the uptrend is intact here on the weekly chart, even though we've been seeing some weakness. Gold is really not doing anything. And I don't know if I mentioned it in last week's video, but I was listening to a podcast a week or so ago with a gold expert, because everybody thinks, well, with all that's going on right now, why isn't gold going up? Everybody said it should be going up, but it's just not going up. And they asked him why. And he says, I don't know. Gold should be going up and it's just not. And so that's really having a lot of folks confused right now. Silver has also been having a lot of trouble lately. Oil, after really getting up high, settled down around 107.62 on Friday. The dollar's still been hanging in there. It was down about 0.5% on the week, but it's still doing okay. Looking at bonds and interest rates, where we might have bottomed out with bonds, and that could be positive too, where we might have hit some support in this area. And if bond prices can start to go up, that would start to bring interest rates down. And this is one example where we broke above this resistance level with the 10-year treasury yield. Well, we came back down below that. And here's another chart of the 10-year yield where we broke above 100% retracement. That had acted as support. Well, now we broke down below that. Are interest rates starting to fall? That's the question we're asking right now. They were up overall in the week with all the different maturities. And then to show you internationally, we were down on the week. And Japan is still staying down really low right here because they've got other problems on their plate right now. Some relative studies just show the bonds have been outperforming stocks lately, but seeing some recent weakness. On a monthly chart, stocks have been really outperforming bonds, but not lately. Oil still, even though it's seen some real weakness, it's still the best performing asset out there, with the dollar in second place, and gold is just barely hanging on positive. Stocks are trying to bounce up, but still negative. Bonds are still turning down and are the worst performing assets so far since the beginning of the year. The gold to the US dollar ratio continues to fall because gold's going nowhere and the dollar's still holding up. Gold to the S&P, even though the S&P has been having trouble, gold has been going nowhere, but it's still in an uptrend overall. Gold is still outperforming the S&P, but we need to keep an eye on this. This could drop down below this moving average. The low volatility stocks, they are still outperforming the rest of the S&P 500. And growth value. Growth is still underperforming. There's no doubt about that. But see this little spike up here? We want to keep an eye on that. On some of the daily charts, it's a little bit more pronounced. So if we're seeing this, if this is starting to turn back up, that could be very positive. NASDAQ 100, which is more growth oriented, against the S&P 500, which is growth and value, also showing a bit of a turn up. The S&P 100, which are more growth stocks against the rest of the S&P, is also showing some improvement. Discretionary didn't really bounce up. Here it says that the ratio was up 1.5%, but that's just a little tick on this chart, but it is showing some improvement. Energy has really been going down lately, where tech has been seeing a little bit of a rebound. So that's why this ratio has come down a bit. So then what's our outlook for the upcoming week? Well, on Monday, we have durable goods coming out as an economic report. On Tuesday, consumer confidence. Wednesday, that's the biggie, even though it's not the final number. So it could be big, it might not be that big, but it still might give us a little more insight to what's happening when the GDP report comes out. Thursday, we have PCE. That'll probably be the big one for this week. Friday, we also have another big one, which will be ISM manufacturing. And then there'll be the non-manufacturing one that comes out after this later on, following week. So this is what the Fed really uses to measure things. So we'll want to keep an eye on that. So our technicals, they're still negative on the weekly charts. Inflation and interest rates are still the big concerns. We have a lot of geopolitical issues happening right now. Russia, Ukraine, supply chain, the things that I mentioned at the beginning, they're still there. Nothing has really changed. We want to keep an eye on oil. Anytime, especially Chair Powell speaks, what are they saying? Is it more hawkish, which means they're going to likely raise interest rates, or is it more dovish, which means maybe we'll start to lower interest rates? The market just listens for that. Earnings as they're released, Japan, and if we continue to fall, there might be some concerns about margin calls. People that buy stocks using borrowed money, if it falls to a certain level, they have to sell it, even if they don't want to sell it, just because they have to be able to pay back the money that they borrowed from their broker. So what are our scenarios? We're still down overall because of all the reasons. There's one more to mention here, domestic unrest. I don't know if that'll be an issue or not. I'm recording this over the weekend. In the previous week, the Supreme Court released some decisions, and that could cause some problems. Whether it's going to cause problems or not, I don't know. If that is going to have any kind of an impact on the stock market, I'm not really sure that it will. We had a lot of problems back in 2020 and even into 2021 that didn't seem to really impact the stock market, but just be aware of that. The technicals on the daily charts anyway are starting to turn positive, where they're still decidedly negative, but showing improvement on the weekly charts. What could help us go up? The technicals are showing some improvements. There's a real disbelief now. The market's never going to go up ever again as long as I live. That's when it usually goes up. And these possible positive setups, especially the potential rotation that we might be seeing from value over back into growth, that could be quite positive. And that's kind of what I mentioned right here. The technicals, they're still pretty negative overall. So we can look at different fib retracement levels, which we regained an important one this past week, different pivot points, whether they're on daily or weekly charts, and then previous highs and lows. That could provide either support or resistance. We're not neutral right now. So the third scenario is really not viable currently. So thank you. Have a wonderful week. I hope you found this video beneficial. Please feel free to check into some of the daily videos, as I'll be updating this rotation scenario each day that I post a video.